Hey, everybody, welcome to the show. So, I think one of the biggest mistakes that we can make as a business owner is really treating financing like it's a one size fits all solution. But today, not all businesses have the same cash flow cycles, growth plans, operational challenges. And I think developing the right capital strategy inside your business isn't just about getting approved, it's about finding financing that actually supports the way your business operates. So, today we're going to talk about why growing businesses often experience cash flow pressure, financing options that many of us probably don't realize exist, and how to think strategically about capital before it becomes an emergency. So today's guest, Don Brown, is the CEO of Beacon Business Capital, and he spent nearly 3 decades helping business owners just like us navigate these types of decisions. And he's helping us identify the financing strategy that will best fit our business, not just the product that's easiest to sell. So, Don, welcome to the show. I'm so
Thank you.
excited to have you here.
I'm glad to be here. Thank you for the interview today, Krista.
So I'm really interested because you talk about yourself as being a capital advisor or an intermediary. So for everybody that's listening, talk to us a little bit about what that actually means and how you're working with businesses.
Good question. It means different things to different people, and I can't speak for all capital advisors or intermediaries, but the way I operate is that I never charge my clients any fees up front nor later at all, meaning that what I do is I kind of listen to your story, understand what your needs are, where you've been, where you're going, what your goal is, and what your primary need is at this time. And I kind of share with you what solutions might exist. As you mentioned, I've been in commercial finance for 30 years, so I have developed a deep bench of lenders that I've operated with for quite a long time, so I'm very familiar with them. And if I can't provide a solution that makes financial sense to you, then you've left with no fees whatsoever charged by me. So it makes sense to me, and I think you would agree that it's kind of like fishing off the pier yourself, for instance. Your reach is only so far. If you get in the boat with me and I take you to where the good fish are, I think you'd think that would be a great opportunity. Even if I show you something that ultimately is not a fit, well, we go somewhere else and we look at something else. So that's kind of what I do is I work with clients. And when I can't help, or if it's some type of financing that I don't really specialize in, I'll share that with you right away as well.
So is this somehow different than, say, I'm looking for money and I end up working with a broker?
Yeah, I mean, you could call me a broker, so to speak, but brokers work different ways. Oftentimes, brokers make you sign some sort of agreement, and they take some capital from you up front, and maybe more capital from you later. And on top of that, they're also getting compensated by a lender. So I don't operate that way at all. I share with everybody up front, completely transparent, that I'm here to determine quickly, can I help you? And then we identify some solutions, discuss those, and then we decide to proceed with some underwriting or some pre-approvals to see if it is indeed a solution that makes financial sense to your company.
I love that. So I think a lot of business owners, or as maybe a lot of business owners can relate to this, there's times when I've really thought about financing as, the ultimate goal, being approved for financing, whatever I could get as being the ultimate goal. But I'm starting to think now that it's really about building the right capital strategy instead. So how do you define a good capital strategy for a growing business?
Well, a good capital strategy is something that's going to help somebody reach their goals, help them grow their company, and perhaps educate them on the existence of products that they didn't even know existed, quite frankly. And that's what happens probably a third of the time that I interact with companies, is that they've approached me thinking that they want this particular type of loan because they didn't know something else existed that is as good, if not better. So that's kind of how once again, it's the story of kind of where you've been, where you're going, and what you're trying to accomplish, and to develop a strategy with them with their agreement that, hey, this does make sense. I didn't know that I could obtain this type of financing or that it even existed. let's take a look.
What are your, favorite types of financing to work for with your clients or to suggest or recommend to your clients? Because as you've said, there's a lot of different types of ways that we could go with financing, but what do you think actually works the best for most businesses?
Depending upon the scenario, what they really need and what they're looking for, there's a wide variety of loans, as you well know. I started my career out in kind of asset-based lending and factoring many, many, many years ago. It was a well-defined space. After I kind of went to a couple of different banks and expanded my horizons and learned about different loan types, from SBA lending to equipment lending, for instance, whether it be mortgages or even hard money loans, which, hard money sounds expensive, and it sounds, when you hear the phrase hard money, that sounds tough. Well, it has its place out there. It's fast, and it's refinancing, and you can get some capital back out of it if you have a lot of equity in a property. So there's a lot of different types of financing, and I have some solutions in those categories as well. But where I spend most of my time and where I want to kind of speak toward today is unsecured revolving lines of credit. That is a product that I have that is predominantly industry agnostic. I can serve about any type of business out there. And how it's designed to work is to support or complement senior debt or senior financing that's already in place. So companies that already have bank lines of credit, or they have asset-based lending or factoring or an SBA loan or senior lender that's in place, that's encumbered their assets, I can still come behind that without upsetting the apple cart, causing any difficulty with covenants that may be in place with these lenders, because my primary product that I help companies with regularly doesn't require any collateral and doesn't require a UCC lien filing, which, most lenders, of course, are going to take a UCC lien position. That essentially tells the lending world that here's the collateral that I have encumbered, and we have a first position on this, that, and the other, typically inventory, equipment, receivables, real estate, things of that nature. So what our product is designed to do is, again, complement up to a couple $1 million or so of additional revolving lines of credit that can be used with great frequency, or it can be used infrequently if it's seasonality or simply to fill capital gaps that a company, experiences from time to time. And everybody has capital gaps now and again. So a lot of people see the wisdom in having an unsecured line of credit to backstop what they've presently got going on.
So what are the consideration factors? So if I'm a business, and as you've said, I have a senior lender in place and my assets are encumbered, what are you specifically, or what are the lenders that you're working with specifically looking at to say, yes, this business is in a good position, we can go ahead and come in behind with an unsecured line of credit? Because that sounds like a fantastic solution.
It is. And just as an aside, it might not exactly be what you're looking for, but when you discover there's a product like this available to you, and if it makes financial sense to you, it's great, because I can solve some short-term problems pretty quickly. So to answer your question, high level, the criteria to qualify for the loans, and by the way, the revolver rather, ranges from $50,000 and it goes up to $2.5–3 million. So that's the range. Your company needs to have been in business a minimum of 2 years, so you need to be established. You need to be doing at least $2 million a year in revenue, and you need to be profitable or near profitable. So the longer time in business, the more revenue you're doing, the more profitability you have, the higher your line of credit is going to be naturally. So those are the three primary criteria. Now, secondary criteria, naturally, they like to see that a company has established senior lenders in place, or at least up until recently, maybe they've parted ways with they've paid off a line of credit or for whatever reason parted way with their bank or senior lender at present. But up until recently, they had something in place so that when we kind of do some underwriting and look at the credit background, we can see that they have been serving the debt on the loans okay, and that there's creditworthiness established there. So we're not necessarily looking at credit scores with this product. Naturally, we're interested in knowing a little bit about the owners, and if there's any, something crazy like a 500 credit score, naturally somebody's going to want to inquire about that. But we're not focused on credit scores. So that's the base criteria.
Is there any sign that you can see that would tell a business owner if they have the wrong kind of financing in place within their business, even if it's something that they were approved for?
Yes. I mean, something that jumps out at me right away would be that, unless you have a very small merchant cash advance or an MCA loan, that is clearly being used as a quick tool that you have easily been able to manage. There's a lot of companies that unfortunately have gotten involved with MCA or merchant cash advance loans, not truly understanding how it's going to work and the interest associated with those. So from my side of the desk, MCA loans, that they have their place, they're quick and easy to obtain. But what clients don't understand is that it makes it really tough for them to get other types of loans, whether it be this unsecured revolver or almost any other type of loan out there. You've kind of put yourself on the radar of all lenders of, you probably have some real tough issues going on in your company if you've taken a merchant cash advance. So the way we look at it is, if you have a smaller loan relative to your business revenue and everything, and you've used it as a quick tool and it's obvious you could pay it off if you really wanted to in the near future, we could approve something like that. But somebody that has really been utilizing those and might have stacked MCAs, they might have 2, 3, 4 in place, that would be a quick decline. That type of loan would be a decline right away. And I have a solution we can talk about later for that too, but that would not be a good candidate for this type of loan.
So what would be something that would put a business in a situation where they would be stacking, MCA loans like that? What's happening behind the scenes that you can see where a company is thinking to themselves, I'm going to do this once, and then a second time, and a third time, and a fourth time? Because it seems to me like that could create some other types of pressure within the business, or even become kind of a merry-go-round that you can't get off of.
It is. And again, it's, the companies that know they have a plan in place and they have the wherewithal to pay off a merchant cash advance in a relatively short period of time. We're not speaking about those companies. The companies that I see often are taking them is that they have big capital gaps. They're maybe selling a lot on credit terms, or they have slow cash periods of seasonality and they're growing and they've needed capital, or they've taken on maybe a project, but they really didn't have the capital to mobilize into it and sustain themselves and everything that they need to do, whether it be production, manufacturing, or buying materials as a contractor going to in the construction space. And they got to meet many payrolls. So they take the fast, easy money. MCA loans are renowned for being quick and easy. The credit score, personal FICO scores aren't really that big of a deal at all. They look at where you've been very recently in sales revenue and a forecast of revenue as well. And they give you, here's your sack of money, and let's say you've got $100,000. Most often the payments are actually drawn out of your account daily. Now, some of the payments might be weekly, but more often it's daily, and it moves. It's a moving target. It's not a structured loan. It's a percent of your deposits. So as your deposits increase, so does your payment. And it was great getting the money, and it gives you some pretty temporary relief. But after you've run through the money, what you're left with is these onerous daily payments. And if your cash flow is not good and it's not stable, there could be some times where they go to draw funds and it's set up automatically. There's no money in there. and now you've penalized yourself with some, extra fees, so to speak. Your fees could go up entirely because you're in a form of default. So there's trouble. How do you solve it? Well, if you haven't stabilized and you don't have constant money coming in, well, the best solution is go get another sack of cash or another MCA loan that allows you to pay this first one and give you capital for a while. And then it can just simply become a vicious cycle where you've taken a third and a fourth and you're just trying to keep all the balls in the air. And then you find out the hard way that there's no way you're going to get a bank line of credit or anything institutional type of loan at all. There's no way you're going to get any SBA loans. But even in the asset-based lending world and even in factoring, where factoring is a far more legitimate form of financing because it's just advancing you against the work that you have performed. It's not betting on something you might do later. You're actually doing it. It's just so you don't have to wait on credit terms that you get an invoice funded. So the MCA loans are very tough, and the interest rates associated with them can range from 60 to a couple 100%, depending upon what you have signed. So they use words like a factor rate because they really try to fool people into thinking it's factoring. Sometimes, I'm not saying everyone's guilty of that, but a factor rate of 1.35%, well, you're going to pay back 135% of what you've borrowed ultimately. And it's, like I said, it's going to be very, very difficult on your cash flow. So those types of loans, if you're involved with one of those that you cannot easily manage, that would be an auto decline for an unsecured revolving line of credit. We're working with more established, more stable companies to provide the type of financing that's unsecured. But the upside is that it is industry agnostic, as I mentioned. I help a wide variety of companies that have different types of financing, whether it be construction contractors, whether it be manufacturers, wholesalers, distributors, the healthcare industry, even temporary staffing companies that use ABL or factoring. Sometimes they get in a jam. They don't have invoices right up front. If you go put 90 new people out on a project tomorrow and you don't get paid for 45 days from now, you've got to meet payroll, but maybe you don't get to invoice every week. Maybe you have to wait every couple of weeks. Well, you've got to make some payrolls yourself to mobilize into that. The cash has to come from somewhere. And having a standby line of credit that you can draw from to meet that payroll is very important. But I don't want to perseverate on payroll because the line of credit is for any business purpose. So that's why it's so useful, because it's for just about any type of industry. And you can use the money from payroll to pay rent, to buy materials, to cover production gaps of meeting payroll and putting something together, that maybe over a 90-day, 120-day period. And then invoicing and waiting to be paid, that's a long gap. So maybe I'm talking too much, so let you interrupt me.
No, you're absolutely not. Thank you, because you gave us some really good concrete examples there. I think the next thing I'm curious about is, where does more traditional banking come into play here with businesses? So, obviously there's a lot of different types of alternative funding products on the market, but where do you think banks are really well situated for businesses? And then where are they simply not designed to meet the needs of a growing business?
Well, in my travails of where I've been, when I've worked for banks, I've worked in the ABL department. So, for instance, I'll give you on the high side, I've worked for a couple of companies that we were acquired. I worked for actually two companies. We were acquired by Wells Fargo. The second time around that it happened, I went ahead and went to work for Wells Fargo in their ABL division. At that time, it was called Wells Fargo Business Credit. Now it's called Wells Fargo Capital Finance. But in that department, underwriting, you had to be darn near bankable. And you asked about speaking toward, where do banks come in the best? Well, banks are going to be your cheapest money. And I encourage my clients, and I will ask you, and I would say, Krista, have you gone to your bank Have you gone to another bank? Have you asked for this particular type of loan that you're seeking? Because if you're bankable, that's really where I want you anyway. I mean, that's everybody's goal, is to be in the bank, because that's the cheapest money. But it also is the strictest environment that you can be in, from one quarter to the next. If your company is having some great difficulties, you can be invited to leave the bank. And to get out of the bank, you're going to have to pay off the bank at some point. They're not going to give you any more money should you actually have a revolving line of credit with them. But you can be in an SBA loan from the bank. And by the way, there are different types of SBA loans and lenders out there. There's not only strictly bank lenders, but there's also private lenders that are providing SBA loans too, that their criteria is easier to qualify for than banks are. But nevertheless, bank SBA loans, come with some tough covenants. I'm working with a client I just spoke with this morning that he's got to get out of there because the covenants are so strict. His company he wants to sell his company. He has a buyer right away. And then the company he's going to join, they're going to go public. But none of this can happen because they gave him a wonderful loan on equipment. But until that's refinanced, he's got to go. So it's a very strict environment, how you're able to maintain your relationship with the bank. And if you've been looking for money long enough, you'll learn that banks like to give you money when you really don't need it. When you're stable and doing really well, that's the best time for you to approach a bank and begin a relationship and put some financing in place. When you need money, well, there's issues and there's problems and there's pressure. You're less likely to get it, or you're less likely to come anywhere close to the amount that you really need. So hence the secondary private market that I've lived in for a lot of years, that there's a lot of very reasonably priced private money that fill the void of where banks are. Because, let's face it, banks are going to turn away, 70% or so of the companies that apply to them because they just simply don't meet the criteria. So this is, again, the product we're speaking about is for a little bit more well-established companies that are doing okay, but they don't have to do anything different. They might have already gone to their bank and you might have a $5 million credit line, but it's just not enough. Rather than having to pay off the bank and exit and do something, wouldn't it be refreshing to know that you can have an unsecured revolving line of credit to support that you can use for any myriad of different reasons? And so you get to keep your good, well-priced money, change nothing whatsoever, not interfere with that because there's no UCC lien and no collateral requirements. And now you have a lot of extra capital to work with.
So you just touched on something a moment ago that I think really speaks to timing. And, you said that banks like to give you money when you really don't need it. And so in your experience, are you seeing business owners waiting too late to start seeking financing? And if so, what kind of warning signs would tell you as a business owner, I need to start thinking about this right now?
Well, the warning sign really is pressure and problems within your business. It's gotten, to a troublesome point. Well, from an underwriting perspective, banks like to use the word volatility pretty easily, and volatility can simply mean growing too fast. Your growth is accelerated so quickly, and banks are conservative organizations. They like to see slow growth and stability rather than very rapid growth, because that's scary. That's not good. That's a higher risk scenario for them. So from a company's perspective, while if the possibility exists, while you're stable and or doing well, go establish those relationships and put lines of credit in place, and even use them to a degree. Even if you don't need them, just to begin developing credit at the bank, because when there's pressure, that's when you're least likely to be approved. And I will tell you this, and I think a lot of people would agree with me, that banks are renowned for dragging things out when it comes to decisions. You can waste 3 to 6 months in a bank and finally come out with the word no, especially if you're a customer of the bank. Let's just say that you have all of your deposits, had a few year relationship, and you're trying to get a line of credit, or maybe you have one, maybe you have a couple $100, get it, trying to get 200 to 500,000. Well, the bank doesn't want you to leave the bank. They really don't want to have to tell you no. They're kind of hoping you go away and the problem resolves itself, and they'll kind of put you through underwriting. But, ultimately, I think you'd be pretty disappointed if you wasted 90 plus days and you finally get a no, because most people, when they get a no, that's when they go start shopping other banks. And, so the process, there's nothing rapid about doing anything at a bank. And I'm not a proponent for making something happen for you in a couple of business days, because that's a MCA type of loan where they put money on you really fast, really expensive, and it really turns out badly for 70% of the people out there. It's a tough scenario. So if you have a pressure situation, the likelihood of you getting approved by a bank is lower, and the likelihood of getting enough money is less as well, because of whatever your situation is, where there's been pressure and trouble. So an unsecured revolver, just to let you know the time frame, it's not overnight, but you're talking about 2 to 3 weeks, where you might wake up with $250,000, $1 million extra to work with. That's a reasonable period of time. And we like getting to fast yeses and fast nos. That's what I like doing for my client. We conversationally talk to it and say, does this sound like something that will work for you? I ask you questions about your company to determine, in my mind, what are the percent chances of this person's going to be approved? And if I know you're going to be approved, it's just down to how much could you be approved for? And I would say, Krista, here's a short list of records that I need: tax return, end of last year's financials and year to date, and AR and AP aging, no application to fill out, just with those records. And 2 to 4 business days, I can come back to you and say, here's what your pre-approval estimate looks like. Here's what they're thinking about providing you in the way of a line of credit. And whatever number it is, I would say half the time you say, well, gee, I really was hoping for $1 million. And I say, well, Krista, here's $500,000. Does it make sense to take the $500,000? Because until you find something, this can be used for anything. And here's kind of what the cost might look like. Does it make financial sense? So I try to make it easy from that perspective.
So, Don, if you could leave everybody listening, all of our business owners, with just one piece of critical advice that would help them get started building a stronger capital strategy before they need financing, what would that be?
Before they need financing? Well, whatever they are doing in their business right now, I would have good accounting practices, and I would have a good CPA that's keeping your books up to date. So when you have the need, that you can right away have good, legitimate financials ready to be reviewed. And I would say, if you're just operating on credit cards for your business, corporate credit cards, or you might even have a little equipment lease or wherever, pay your bills on time, all the time, or even sooner, so that when you finally do go approach a bank or a private lender, the likelihood of you being approved from everything from a personal credit, you're keeping up to speed with all of your own personal debt, as well as your business credit also. It's not a bad idea, if you're a small business, doing $500,000, million plus a year, maybe it would be good to get an account. What's the credit agency? Dun & Bradstreet. Yeah, go open up a Dun & Bradstreet account and report. That's part of the thing. I've met many people that have a Dun & Bradstreet, but they don't report any information. So they might have a D&B number, but if you don't keep up with reporting your information, then there's no credit really to review. So what credit there is to review, make sure that it looks good, because slow paying everybody, and your paydex score, which kind of tells the world how you pay your bills, when it's dragged out really badly, and naturally any charge-offs or debt left behind unpaid is going to be very troublesome for your future.
Thank you, Don. So can you let everybody know how to find you on LinkedIn, connect to you on social media, and then how to find you on the internet as well?
Yeah, I am on LinkedIn. My name is Donald Brown on LinkedIn. I go by Don Brown, but look me up, Donald Brown. Company name is Beacon Business Capital. I'm here in the Houston area. I serve businesses nationwide. You can reach me by email. The easy way is just info@Beacon, BEACON, Business Capital, with the AL ending on capital, of course. So info@beaconbusinesscapital.com. That's my email address. Be happy to hear from you at any time, answer any questions at all.
Thank you again so much, Don, for joining us today. You've given us a lot to think about, and some really great actionable steps that I think we can start to take immediately to make sure that we do have a good capital strategy on board and we're thinking about things the right way, starting with having good accounting practices. So thanks so much for being our guest today, and until next time, everybody.
Thank you, Krista. Appreciate it.